Hi, well, good afternoon, everyone, and welcome to today's webinar. My name is Megan Peasley, and I am the Iowa Sourceling Program Coordinator at the University of Northern Iowa's John Papajohn Entrepreneurial Center. Here, we work with the Iowa Economic Development Authority to bring the Iowa Sourceling platform to all business owners. Whether you're looking to start, grow, fund, or even exit your business, Iowa Sourceling is here to help you. We provide step-by-step guides, make helpful referrals to our nearly 400 partners, and house the Business License Information Center. We also have the pleasure of presenting these webinars in partnership with the Iowa Department of Revenue. In today's webinar, Kurt Koenig will be providing an overview of the withholding income taxes for the 2025 tax filing year. Before we get into that, I have a few housekeeping items to go over. Today's webinar is being recorded and will be available within the next week. You will receive a link to today's recording in the same email that you will receive as proof of your attendance. The slides for today's webinar will be shared momentarily in the chat box by Sophie Troxel. Sophie and I will be sharing other resources and contact information if and when they are brought up during the webinar in the chat box. If you have any questions, please enter those into the Q&A box located in the bottom half of your screen. We do ask that you focus on asking general questions that could apply to everyone. If you have a question specific to your situation, we recommend that you talk to the Department of Revenue directly. We're going to hold off on answering any of those questions that come in until the end. And with that, Kurt, I'll let you take it away.
All right, thanks, Megan, and thanks everybody for joining today. Today we're going to cover withholding tax. As Megan mentioned, I'm Kurt Koenig. I'm the Individual Income Tax Policy Director for the Department of Revenue. Here's my contact information, just in case we don't get to your presentations during the slide. Please feel free to reach out to me, and we'll try to get those questions answered for you. And with that, I need to throw our disclaimer slide up so that everybody's aware that this presentation really is just for general educational purposes. Nothing should be construed as legal advice. But obviously, I'm going to give you the best information that I have. And if you do want some advice that is binding upon the department, you do have the option of filing a petition for a declaratory order. And I've got the applicable administrative code rule listed on this slide. Here's the department's mission, vision, and our value statement. Things that are important to the department is just making sure that people comply with tax filing obligations. And like part of my role as a policy director is just to do my best to make it easy for taxpayers to comply with that tax filing obligation. So with that, let's jump into the overview for today. We got a lot of topics that we're going to cover. This is going to be like a high-level overview of things like who's required to withhold, how to make payments, payment frequencies. We're not going to dig directly into like GovConnectIowa and how to set up an account, talk a little bit about filing a return. We've got a lot of videos on our webpage related to that, but I just wanted to cover withholding in general so everybody understands when there is a withholding requirement and when payments are due and how to file like W-2s and 1099s. We'll cover that later on. So let's continue to roll forward, and we're going to start off with who's required to withhold in the state of Iowa. Pretty straightforward generally. If you're an employer and you're maintaining an office and transacting business in the state, and you're required to withhold for federal purposes, and that's under Internal Revenue Code section 3501 through 3404, then you're required to withhold for Iowa purposes. If there's no federal withholding requirement, there's no Iowa withholding requirement. And you're not required to withhold for Iowa purposes if the income is not subject to Iowa income tax. And we're going to talk about that shortly. So I'm going to roll forward to Iowa Administrative Code Rule 701, 307.1 is kind of the section that we're going to hang out in right now. And that addresses payments to individuals that are not wage payments. And a lot of those are going to be like profit sharing, stock bonus, deferred compensation plans, individual retirement accounts. Similar to the wage withholding, income is required for Iowa purposes if it's required for federal purposes. And again, if it's not subject to Iowa income tax, there's no withholding that's required for Iowa purposes. So I'm going to jump back a slide again, just like individual retirement accounts. A lot of you are aware that for tax year 23, it was the first year that retirement income wasn't taxable for Iowa purposes if the individual's age 55 or older or disabled, or they had an insurable interest in the deceased taxpayer. So if you have a qualifying individual, there's no Iowa withholding that's required. But if withholding is required, then the applicable rate is going to be 5% of the amount distributed, or 5% of the taxable amount if you can determine what the taxable amount is. And then I want to note that rolling into tax year 25, our rates drop down to 3.8%. So that's a good thing as well. And then taxpayers also have the option of using the published withholding tables by the Iowa Department of Revenue. Pretty easy so far. Let's just keep rolling forward. We're going to dig a little bit deeper into Administrative Rule Code Section 307.1. And this kind of covers the same thing where we're talking about these retirement plans that we've covered before. Covers annuity, life insurance plans, and everything's the same. There's federal withholding that's required. There's Iowa withholding that's required. You might have a situation where you have an annuity and you made a payment into that annuity on an after-tax basis. So I've got basis in it. Again, like I mentioned on the earlier slide, if you take a distribution, you can determine the amount that's actually taxable, the amount that wasn't contributed on an after-tax basis. You only have to pay tax on that portion. And again, the rate's 5% or 3.8% in tax year 25. If a taxpayer makes an election to have withholding on retirement income, the payee should honor that until a new election is made by that individual. But talking about retirement distributions, I just want to point out something. I'm going back a slide or two again. We've noted in our administrative rules that generally distributions from deferred compensation plans are not considered qualified retirement income unless it's a distribution from a 457 plan. And also annuities, if they're not housed under a qualified retirement plan, that's not considered a retirement plan distribution for this purpose only. So those would be subject to withholding. I just want to point that out while we're here. Sick pay benefits, is withholding required on those? Again, I'm just going to keep repeating myself. If it's required for federal purposes, it's required for Iowa purposes. So if your sick pay benefits are administered by like a third-party administrator, there's no federal withholding that's required. So there's no Iowa withholding that's required. So you're not required to withhold Iowa income tax, but the payee could elect to have withholding done on those distributions. And if they do, for 2024, the rate's 5%. But if the payments are not paid by a third-party administrator, they're considered taxable for federal purposes, and they're subject to withholding for federal purposes. So you are required to withhold for federal and for Iowa purposes if you got like a self-funded plan. And I think the logic is it's kind of tough to differentiate between, was this really a sick pay benefit that was distributed, or was it just another way to distribute a wage? I don't know, but I just want to throw that out there for you. Withholding for non-residents, this is going to get a little bit murkier, and this is where we might have situations where maybe taxpayers aren't withholding where they should, because generally if you're a payer of Iowa income to a non-resident, then you're required to withhold and pay withholding tax on distributions to those non-residents. The first bullet point out on here is pretty straightforward. If you got a wage to somebody that you're paying in Iowa, an employee, you're going to treat them just like any other employee, with the exception of Illinois residents, and we'll talk about the Iowa-Illinois Reciprocal Agreement in a bit. But generally, if you've got a resident or a non-resident working in Iowa, you're going to follow our Iowa withholding tables, and you're going to withhold Iowa income tax. All other payments are going to be subject to withholding also, and the rate is going to be 5% on those distributions. The song's getting old, isn't it? Or it's going to be 3.8% in tax year 25, but other payments are going to be subject to that withholding. And to get an idea of what some of these other distributions are, this is not an all-inclusive list, but we're going to look at Iowa Administrative Code Rule 701-307.42. First one, easy peasy, salary, wages, commissions, fees. Yep, just like any other employee, you're going to withhold Iowa income tax on those distributions. But here's some other ones that I want you to think about. Payments for rents or royalties from real or personal property located in Iowa. There's a commercial building, I'm paying rent on it to a non-resident. I'm required to withhold on that and make distributions to the state. Interest or dividends that are derived from securities within the state. And that's only if it's associated with a trade, business, or profession. If it's just a regular investment, you don't need to withhold on those. But if a business is, let's say, in the business of like loaning money, that interest is going to be subject to Iowa income tax. Number 4, income derived from any business of a temporary nature in the states. You've got construction contractors that are coming into Iowa because we had a lot of damage this past year. We've had some disasters, and maybe some people are coming in to repair houses and stuff. You are required to withhold on distributions to those non-residents that are coming in performing construction contracts in the state of Iowa. And the list goes on. You've got non-residents, attorneys, physicians, engineers, accountants. You're required to withhold. Those rustlers that you pay to come in on weekends to entertain, you're required to withhold on those distributions. If you have compensation for services for personal services, if the non-resident comes in Iowa, you're required to withhold on those. If you're an Iowa business and you're paying somebody out of state to perform the services, then you're not required to withhold on those because they're not performing services in the state of Iowa. And then we've got some commissions. Let's talk about those. You've got a salesman, they're performing sales within Iowa and without Iowa, and now you're paying a commission for their performance for the whole year. You've got to do an allocation of the income. You want to determine the portion of the sales that were conducted in Iowa versus all the other sales to determine how much of that commission should be subject to Iowa withholding. Number 9, payments to landlords by agents, including elevators for grain and other commodities that are received as rent. That's going to constitute income in Iowa. And again, you've got to withhold on those distributions. And then I've got a form here that I linked, and grain sales also for non-residents, we would be required to withhold. But if the agent fills out this Iowa income non-resident form, which identifies, the location of the property and the amount of payments that were made, and they submit this to the department by April 1, then they don't have to withhold on those distributions. Railway companies, airline companies, the withholding for like railway companies is really going to be the state of residence for someone that's employed by a railway company. The airlines is generally the same. Plus, they take it one step further that if you perform more than half of your services in Iowa, then you're required to withhold, even though you might be a resident of another state. But special rules related to those. Then you've got merchant marine companies. Those might be companies that are transporting goods up and down the Mississippi River. And we're primarily going to look for the state of residence of those individuals on where withholding is required to be withheld. Okay, so if a non-resident doesn't want withholding done on the payments that are made to them, one thing they can do is they can complete a non-resident certificate of a release, and I've got that attached to this form here. And what they can do is make an estimated income tax payment, and then they won't be subject to withholding. So it's not estimated income tax payments. When you complete this, you're going to indicate who you're going to perform services for, how much money you're going to receive, and you're going to calculate the amount of tax to withhold, which is going to be at the 5.7% rate this year, 3.8% next year. And you're going to make a payment to the Department of Revenue prior to the time that you start performing any services in the state. And then if it's approved by the department, they'll send notification to the withholding agent saying, yep, we got the withholding on $10,000, and you don't have to withhold, assuming that you don't go over that $10,000. If you do, then you're required to withhold on any distribution. So it's not like I can just make an election and make 4 quarterly estimates. I'm paying it all up front before I receive $1. Sorry, I need a little drink right there, just to keep going. Okay, we'll backtrack a little bit. You've got your business, and now you hired an employee. What do I need to do? And I think most of you know the first thing I need to do is give them a W-4 form prior to or on the day that they commence employment, and they've got to complete that form before they start performing services. And then I'm required to hold on to that W-4 form for 4 years. And the W-4 form, most of you know, that's where you report your allowance amounts that you're claiming for the year, and that's how we calculate the amount that's going to be withheld each pay period. Down at the bottom of this form, I've got a link to where you can find the Iowa W-4 form or the federal W-4 form. So pretty simple so far. But what happens prior to the time that they come? I give them their W-4 form, they work, and now it's time to pay them, and they didn't give me the form yet. What do I do? If that's the case, then you just assume they have no withholding allowances and withhold at the highest rate. But if a taxpayer is not going to be subject to income tax, they didn't owe any tax in the prior year, they don't reasonably expect to owe tax this year, they can indicate they're exempt and not have any withholding from their wages. And that's primarily going to occur if they're below the low income threshold, for filing a return. And for taxpayers that are married, filing jointly, had a household, or a surviving spouse, if their total income is below 13,500 and they're under age 65, they won't be required to file a return, won't be required to withhold. For taxpayers that are single or married filing separately, that limit is $9,000. And then for a single person, if their income's below, and they're claimed by a dependent, and their income's below $5,000, then they won't have to file an IOWA return. They won't be subject to withholding. And then when they turn 65, those thresholds jump up to 32,000 and 24,000, which is a pretty good deal for getting older. I'm sorry, I need another drink again. I'm talking too much. But when you're looking at the total income, I want to point out that you do need to add back some stuff. So I'm looking at my total income to see if I'm eligible for that low income threshold. And if I've got other sources of income, kind of what I need to do is go through and figure out what my Iowa taxable income is. And then I add back my standard deduction, up to the amount of my federal adjusted gross income. I don't want to go negative. And I need to add back things like the QBI deduction and the lump sum distribution and the net operating loss. And if I'm a couple, I need to combine my incomes to see if I'm over that threshold. And I apologize for making that sound complicated, because it is. But I also want to let you know that it's not complicated. If I just have wages and my spouse just has wages, then I really don't need to worry about just adding back the standard deduction, because I would have like income of $10,000 and I would deduct my standard deduction. And then if I add my standard deduction back, I'm back at $10,000. So it's not always real complicated. It's just if you have a bunch of other source income. I do want to apologize. In tax year 24, we did modify the W-4 form, and I don't apologize for making the change because it's good, but change is always stressful. And I'm old. Most of you know I was in public practice for 23 years, and now I just turned 60. That's kind of scary, but not change is just less acceptable to me, I guess. But aside from that, what we've done is we modified the Iowa W-4 form to kind of conform with the federal form, just to make it easier to understand for federal and for Iowa purposes. And what we did is we changed the form so that rather than reporting the number of allowances on a W-4 form. You're reporting the amount of allowances consistent with federal on the Iowa W-4 form. And if you do have employees that submitted a W-4 form for tax years prior to 23, and you didn't get a new one, and you don't expect to go out and request a new one from those employees, even though we highly encourage you to do that. What you can do is take the number of allowances and multiply those times 40. So pretty straightforward. Here's an example. Taxpayer claimed 6 allowances in a tax year prior to 23. You'll multiply that times 40. And for withholding purposes, you're going to assume they're claiming $240 of allowances. And for tax year 23, we reported categories of married filing separately, head of household, and other. And other for this purpose are taxpayers that are filing single, married filing separately, or qualifying surviving spouse. And then we made a few more modifications in tax year 25. These we expect to release here shortly. Not any material changes to the 2025 W-4, but we did move the qualifying surviving spouse rightfully down under the married filing jointly status because they use the same standard deduction. And then under the other category, we also include joint taxpayers that want to withhold at the higher single rate. We put those underneath them as well. We have some Iowa withholding tax guidance on our web page. It helps deal with some different scenarios, which again is very similar to federal. One situation we want to point out is that if you've got a taxpayer that's married filing jointly and you indicate yes that your spouse has earned income, what we direct you to do is follow the withholding tables as if you're a single taxpayer. And the logic behind that is if both taxpayers had their withholding calculated as if they're married filing joint, then both would have withholding calculated as if they were eligible to claim the full married filing joint standard deduction, which would create a problem later on because at the end of the year when they filed their returns, they would be under withheld. So if you're married filing joint, both spouses work, you're going to calculate that as if you're single. Or if you have a taxpayer and I've got more than one employer, we've got online guidance that will talk you through how to calculate the amount of additional tax withheld each period. And this is for the same exact reason. I've got 2 employers, and if I indicate I'm single, both employers are going to assume when they're going through the withholding tables that I'm eligible to claim that single standard deduction, again, which would be in error and could create a tax liability at the end of the year, which we don't want you to do. So we want you to think about that in advance. And then the last thing is for non-resident aliens. Same as above, except non-resident aliens are not eligible to claim the standard deduction. So they're going to need additional withholding as well. So go out and look at our guidance if you have questions related to any of this. What do you do if the W-4 form that you receive from an employee just appears to be incorrect? They're claiming a huge amount of allowances. And what our administrative rules indicate is that if an employee is expected to earn more than $200 a week and they claim that they're exempt, we ask that you submit a copy of that W-4 form to the department. Here's the mailing address. And then the department will review that W-4 form and will notify the employer to let them know whether they should honor that W-4 form or whether they should just proceed as if that employee is not claiming any withholding allowances and essentially withhold the maximum amount each pay period. Let's talk a little bit about withholding tax payment frequency. So I got my employees. How do I know how often I need to pay or file returns? And fortunately, we have all that on our webpage for you if you just search for withholding. But here's the general thresholds for you. If you're expected to withhold less than $6,000 of withholding tax during the year, you're going to be classified as a quarterly filer. If you expect your withholding to be from $6,000 to $120,000, you're going to be considered monthly. And if you expect it to be more than $120,000, then you're going to be semi-monthly. And it's my understanding that annually, your account is reviewed just in case the amount of withholding changes, and you may be notified if your payment frequency changes. I want to point out that if, like, I'm a monthly filer, and then maybe I've got a month where I didn't have employees, seems like a long time. But for example purposes, let's run with that. I didn't have any withholding for this month. We still want you to go in and complete the withholding report and indicate that you didn't have any withholding for a period. Otherwise, our system is going to review your account. You're going to see that you have a period where there was no filing, and they'll send out correspondence. And if you don't respond back to the department, it's going to estimate it on the high side of what that liability should be. So just to avoid any stress for both of us, if you have a period where there's no withholding, submit a report with a 0 on it. So if you're a quarterly filer, you're just required to file quarterly reports, and you can make payments when you submit those reports. If you're monthly, you're going to be required to file 2 monthly deposits and then the quarterly reports. And then semi-monthly, you've got 6 semi-monthly deposits, and then you do the quarterly report. And I've got tables out here for you to follow. And like the quarterly one's pretty straightforward. My quarter ends in March, and then by April 30, I've got to file the report and I've got to make payments. Pretty straightforward. And then the monthly one, like I mentioned, you've got January and February. You're going to make payments in February, by February 15th and March 15th. And then you're going to file a quarterly report, just like with the previous slide. And then there's all the semi-monthly payment dates and the quarter ends where you're required to do payments and submissions. But what happens if, wow, I've got so many different payment periods that I need to follow, and I've skipped one, I forgot one. What happens? Yep, you could be subject to a penalty. And these are the penalties that potentially you could be subject to. There's a 5% penalty for failure to file a return, and you can be subject to that if you didn't pay at least 90% of the tax due by the due date of the return, or a 5% failure to timely pay tax due. Again, that's all based off, did I have 90% paid in by the due date? There could be a 5% audit or exam deficiency payment if the department discovers an underpayment penalty during an exam, charge an additional 5%. And then we do have a 75% penalty for fraud or frivolous returns, or a failure to file a return. And if we do assess that 75% penalty, that's not subject to waiver. Once we assess that, that's set in stone, and you're going to have to pay that. And then we've got a few other penalties that I want to make you aware of. A $500 civil fraud penalty. And this is assessed if we consider return to be frivolous, has false information. You filed a return just to reduce your tax liability. And then we also have a $1,000 penalty for a failure to file a return. And in that situation, if we don't see a return, we'll send out a letter. It's going to be a 90-day demand letter. And if a taxpayer doesn't file a return within that 90 days, it can be assessed a $1,000 penalty. And this is in addition to all the other penalties. And it can be, I mean, for every tax period that's outstanding, it can be for the same tax period. If you still don't file a return after you're assessed a $1,000 penalty. But what if I don't think that I'm subject to that penalty? What you can do is submit a penalty request form, and we've got 17 reasons identified in our administrative rules on when we can waive a penalty that's been assessed on an account. I want to make it clear that Iowa doesn't authorize use of a reasonable cause standard similar to federal. We've only got these 17 stipulated situations where we can waive those penalties. And this comes right off that penalty waiver request form. And just keep in mind, penalty type A is going to be for the failure to file a return. B are late payment penalties. C is for audit and exam deficiencies. And D is a $1,000 failure to file penalty. And I noted again that 75% fraud penalty can't be waived. So here's, I noted that because you can see I've got the A, B's, and C's noted by each of these penalty waiver reasons. And I'm going to go through some that I think may be pertinent to withholding that I want you to make aware of. The first one is pretty straightforward. We talked about it a couple times, where if I paid 90% of the tax by the due date, then I can avoid getting the 5% penalty for failure to file and failure to pay. And if I can just prove that I paid that, that penalty can be waived. And number two, this is fairly new, a 1 in 36 waiver. If I've got a return that's a quarterly or monthly return, and I've paid all my tax due on time, I filed all my returns on time, I can use this request reason and have those penalties waived. But note that this doesn't apply to income tax returns that are filed, corporate tax returns, franchise tax, and annual sales or annual withholding returns that are filed. Doesn't apply to those, but the 1 in 36 is kind of a good deal. For purposes of provisions 3 and 4, you could have a situation where the taxpayer, immediate family member, passes away, or they become seriously ill or hospitalized prior to a filing due date. And if that's the case, you could be eligible for a waiver. But I want to make you aware that in our administrative rules, we make it clear that if somebody becomes ill or somebody passes away more than 30 days prior to a due date, that's not going to be allowed for purposes of this penalty waiver. It's got to be within 30 days of a filing due date before we'll allow those two waiver requests. This past year, we've had a lot of disasters that came through the state of Iowa. Records were destroyed, and some people may not have been able to file their quarterly returns, may not have been able to make payments on time. So you could use penalty reason 5 to exclude penalties under this provision. And there's a lot more on here. I'm not going to dig into absolutely every one of them, but if you can show that there's substantial authority, or you can show that I followed guidance from a previous audit, some of these payments can be removed. Let me see what else I wanted to hit on here. If you can voluntarily file an amended return prior to being contacted before the department, and that would be eligible for a waiver. On number 14, if I set up my electronic funds transfer and then technology happened and it didn't make the payment on time, that's okay. If you can prove that you set it up on time and it was something outside of your control, you might be able to have that penalty and interest waived. And these last two relate to the $1,000 penalty for failure to file. If you can show that you filed an appeal prior to the time that you got this 90-day demand letter, the penalty can be waived. Or if you can show other good reason to the satisfaction of the department, we can waive that $1,000 penalty. But okay, let's go back. What happens if I've sent the penalty waiver request form in and it was denied? Do I have any options? It's like, yeah, once you receive a notice of assessment, you've got a 60-day period where I could file an appeal with the department. And I've got a link right here to that appeal form. And we can go through the formal appeal process to try to get that penalty, tax, whatever, interest, not interest, but penalty and tax removed from your account. And right now, it is taking quite a while. I just don't want to surprise you with that. It takes a little more than a year at times for a lot of these appeals to be processed. So just be patient with the department. And, what happens if, many of you know I was in practice. I owned a practice for 23 years, but what happens if my client didn't give me the notice and my 60-day appeal period passed? Am I stuck? Can I do anything? And this is another reason why we encourage you to go have the business approve you as an authorized third party in GovConnectIowa, so you get a copy of all your notices. But just in case you have this fluke situation where I didn't get the notice, you still have another opportunity. You could file a request for an abatement, and that you can use that to reduce a portion or all of your tax, penalty, or interest. You can't go through the abatement process if you're still within that 60-day period after the notice of assessment. You're required to go through the appeal process first. But if you do go through the abatement process, the decisions by the department are final. You can't appeal those. And any decision to grant or deny is purely discretionary by the department. But I do want to point out in that very last bullet point that you don't go through the abatement process if you just can't pay the amount of tax due. If that's the case, we're going to have you contact the collection department and they can work out a payment arrangement with you. You might be eligible for some sort of offer and compromise process, but deal with collections on that. That's not part of the abatement process. And I'm not going to go into the details on abatement, but I just want to let you know there's other provisions related to that. If you're subject to interest, here's the interest rates for tax year 24 and tax year 25. It's both a 10% annual rate or 0.8% monthly rate on the balances that are due on the return. And here's just an example of how it's calculated, just so it's clear for you. Here's a situation where a taxpayer owed a balance due on April 30 and they didn't pay it till June 30. For purposes of calculating interest, I want to make sure that you know that part of a month constitutes a whole month. So for purposes of this example, the payment was due in April. They didn't make a payment in May, so they owe interest for that month. They made the payment on June 30. June 30 is part of the month of June, so they're going to owe interest for the whole month of June. So they're going to multiply 0.8% times 2. And for this purpose, they're going to multiply the outstanding balance times 1.6% to calculate the amount of interest that is due. I'm going to talk a little bit about filing a withholding report. I'm not going to dig in deep because we do have webinars out. We do have videos out on our webpage, but generally it's pretty straightforward because you've got your GovConnectIowa account set up, and that's one of the first things you want to do. You start a business, go set up your GovConnectIowa account. You'll navigate to the account tab, and then it's pretty easy to select that you want to file a return, you want to make a payment. You're just going to follow the prompts on the screen. I want to make sure that you know that if you go in and you make a payment, that's not the same thing as filing a return. You still could be delinquent on the return. You still need to go file that tax return. So let me jump to the next page. So I go into my account, and it's right down here at the account level for withholding. You can see I just click on that button. I'm going to make a payment. It's going to walk you through it. Or I click on I want to file or amend a return, or I want to view a return that was previously submitted. And then right below that, you can see that you can submit W-2s and 1099s, which you can't do quite yet, but that's where you're going to go to do that. As I mentioned before, on the webpage, we do have videos. So go out and search for withholding, and that's where you can watch videos related to withholding and filing your return. And then see right here, after I got in my account level, one of the first questions they ask you is, do you have to file a report for this period? And if I've got a period that had no withholding, I can select no here. It's going to file a 0 return. That way you're not going to get a letter from the department saying, hey, we didn't get a report for April. File one right away. It's going to reduce stress for both of us. Tax credits, these don't apply to probably most of the people who are on this call, but I want to throw it out there because it's related to withholding. And then in with the slide deck that you got today, there's a couple pamphlets related to these tax credits that can offset withholding, just in case you have team members that need training, and these are some options for you. There's 4 tax credits that can be claimed against withholding. The largest is part of the Iowa Industrial New Jobs Credit, and that's used to support employers that are training new employees. And the 2 credits are the New Jobs Tax Credit, and then if an employer participates in that, they may also be eligible for the Supplemental Jobs Tax Credit, which is another 1.5%. So the total credit that you can get on the wages that are paid is 3%. And then the other 2 credits are the Accelerated Career Education Tax Credit, and that's for employers who sponsor training at community colleges. And then there's also a Targeted Jobs Tax Credit, and this is for jobs that meet certain requirements in targeted communities. So those are the credits. If you want more detail, look at those pamphlets that I've given to you. Otherwise, I'd have you reach out to community colleges or the cities that participate in these programs. when you're submitting your withholding reports, I want to make sure everybody knows that you're always going to report the full amount of withholding that you receive. You're not going to net the credit against them, and you're always going to report the full. You're going to report the credits separately on the withholding reports, because we need to be able to identify and confirm the credits that you're claiming on your return. So for this quarter end, for purposes of this slide, the withholding is $1,200. Even if you're eligible for $1,000 credit, you're still going to report the full $1,200 for the quarter. And then when you go through GovConnectIowa, it's going to ask if you have jobs credits to report. You select yes, and you're going to report each of these credits individual on here. And then it'll eventually net out, because you're going to receive a tax certificate. And here's the mystery behind them. The program codes, I've got those all listed here for the different credits. It's going to indicate the fiscal year. And then it's also going to have a code for the community college or the city, and then just has a sequence number after that. But you're going to report all those at the bottom of this slide. And again, we're going to confirm those credits. And I also want to make sure that you know that you're not going to round these credits up. These are awarded credits. It's not like Iowa Department of Revenue money. And there's caps on these credits that are paid out. So even if there's a credit that's like, excuse me, $1,000.51, when you're reporting that on your withholding report, you're going to report $1,000.51. If you round that up to $1,001, it's going to be more than the credit that was offered, and then you're going to get some notices. So the most you can report is the amount of credit that was awarded to you by the whatever community college or city. If you have questions, again, reach out to the applicable community college or city. If you have questions about GovConnectIowa, reach out to the Department of Revenue. We're happy to answer questions on those. If you're an employer and you come across a situation where you reported all your withholding, you didn't report the credits on the quarterly reports, you need to go back and amend those quarterly reports and claim the credits. Or if you completed you completed the quarterly report, but you netted everything together. I reported my withholding of $200 rather than $1,200. Again, you need to go back and amend those quarterly reports, because when you submit those W-2s at the end of the year, everything's got to match, and it's not going to if you netted those amounts together. W-2 and 1099 reporting. There's a webinar coming up December 11th. I encourage you to go register for that. That's going to talk you through everything related to the W-2 and 1099 reporting. But I do want to point out that there is a $500 civil penalty for a failure to furnish W-2s or 1099s to a payee, or furnishing a false or fraudulent statement to a payee or to the department. So if you've got 10 employees and you don't furnish them with W-2 forms, you could be subject to 10 times a $500 civil penalty, a $5,000 penalty for not giving the W-2s to the employees, and then another $500 penalty for not providing those to the Department of Revenue. So potentially a $5,500 penalty for not providing W-2s to your employees. Again, the Department of Revenue just wants to make it easier for taxpayers to comply with their tax filing obligations. If they don't have a W-2, it's really difficult for them to comply with that tax filing obligation. So this is a mechanism to motivate employers to comply. Iowa-Illinois reciprocal agreement. If you've got a situation where, in this case, there's an Iowa resident that works in Illinois, we've got a reciprocal agreement with Illinois. Illinois has reciprocal agreements with, I think, 5 different states. But the way that this works is the Iowa resident will fill out this Illinois W-5 NR form, and then they'll also fill out an Iowa W-4 form. And then that Illinois employer is only going to withhold Iowa income tax, and that Iowa resident won't be required to file an Illinois tax return, assuming that's their only income that they have to report, and they can just file an Iowa return, except if they do have other income, like maybe there's a layoff and they receive unemployment money, or maybe they take that unemployment money and they go to Illinois and they gamble to try to make up the difference. I don't know what would happen. But if they've got gambling winnings with Illinois withholding, or they've got unemployment, they may still have to go file an Illinois return. But if that wages is their only source income, they have no filing obligation. in the state of Illinois. And the reverse is true too. If you've got an Illinois resident that's working in Iowa, they're going to fill out this employee statement of non-residence, and they're also going to fill out an Illinois W-4 form, and that Iowa employer is just going to withhold Illinois income tax, and they're not going to have an obligation to file an Iowa tax return unless they have other source income, like maybe there's rental property in Iowa, or again, they have gambling winnings in Iowa. In this slide I just threw out there, I don't know, it's just top of mind, but if you're an Iowa resident and you work in any other state besides Illinois, and there's withholding in other state, like let's go the other way, Nebraska, and there's Nebraska withholding, I'm still gonna have to go file that Nebraska income tax return. And on the Iowa return, I'm gonna report all the income on the face of the 1040 like I'm always required to do, and then I can claim an out-of-state tax credit on the Iowa 130 form. So again, we only have that reciprocal agreement with one state. Some common issues. When you start a business in the state of Iowa, we encourage you to go out and you set up your account in GovConnectIowa before you make any payments, before you submit any returns to the department. And then we want to make sure that you identify at least one withholding contact, and that's a person that we're authorized to discuss your account with. They're not going to be authorized to discuss other tax types unless you provide that specific authorization to them. But we need somebody that we can talk to as it relates to, in this case, withholding tax. And then it never hurts to set up some third parties also that are authorized to discuss your account. Maybe if you have like an external accounting firm that helps with payroll, it never hurts to have them out there so they receive copies of correspondence and they can help respond to some of the correspondence that goes out. Another big thing is when I go through GovConnectIowa and I sign up, we want to make sure that you identify a start date that goes back to the date that you really start making payments, because that's going to be the first time that you're making deposits with the state of Iowa. We don't want you filling it out right now and saying, hey, today's my first date. If you do that, then the system isn't going to have those prior periods out there. And if you try to go in and make a payment for the prior month or 2 months or 3 months, it's not going to let you because it doesn't think that you had employees during that period. So make sure that you identify the start date as, I would say, at least the date that you're required to make that first payment, so the system is prepared and ready for you to make those submissions. Make sure you subscribe to updates at the Iowa Department of Revenue. This is where you can get updates from administrative rule updates, or maybe tax guidance that's released with the department, or maybe disaster recovery guidance that's issued by the department. Make sure you go out and subscribe to all of those. And if you have any additional questions, here's our taxpayer service number. You can reach out to taxpayer services. You can send an email. Generally, we try to respond back to a lot of these within a 24-hour period if they're easy questions. Some take a little bit longer. And subscribe to some of our social media posts as well. Again, this is a reminder that this presentation was just intended for general education purposes. Nothing should be construed as legal advice. So those are all my slides for today. We could look through quick and see if there's any outstanding questions before we conclude our presentation today. Somebody asked if the new tax rates are for all income or just the non-wage amounts. And those new tax rates, that's for it's for all individual income tax. Corporate has their own tax rates, but for purposes of individual income tax for 2023-24, the top rate's 5.7%, and then it drops down to 3.8%. And that's for residents, it's for non-residents, it's for wages, for non-wage distributions that went out. With deferred compensation plans, someone was asking, can you repeat what you said about 457 plans? A 457B plan is considered a qualified retirement plan for Iowa purposes. So that's not subject to Iowa income tax, and you're able to take a deduction for that on Schedule 1 of the 1040, but really any other deferred compensation plans are not considered qualified retirement plans, and they're not going to be eligible for the retirement income exclusion. So withholding is going to be required on those other distributions. What's the withholding rule for an Iowa company that's employing remote workers to perform work from another state? With remote workers, what we look at is where is that individual performing services? If let's say you've got a Nebraska company and you've got a remote worker in Iowa, that Nebraska employer is going to be required to withhold Iowa income tax for that individual, and they're going to be required to pay into the unemployment fund because that individual is performing services in Iowa. And also the reverse is true. If you're an Iowa employer and you've got a remote worker in Nebraska and they're performing services in Nebraska, that Iowa employer is going to be required to withhold Nebraska income tax for that remote worker because they're performing services in Nebraska. It's not going to be subject to Iowa income tax because they're not performing services in the state of Iowa. When will the 25 W-4 be available? I was hoping it was going to be done a couple of weeks ago. We're hoping to finalize that. I got to finalize the W-4 form, and I've got to create the Spanish version of that W-4 form. I'm going to check after this meeting to see if we're any closer, but that should be released shortly. Gosh, we had a lot of people ask about that. Should an employee renew the W-4 every 4 years? I don't know that there's a requirement to do that. We modified the W-4 form for tax year 24, tax year 24. And it never hurts to ask your employees to update those. If you didn't update them last year when we made the big change, I think it's worthwhile just give them an opportunity to go through again and complete the W-4 just so it's current. Sometimes, after a period of time, they have like new dependents and stuff, maybe change their filing status. So it never hurts to ask them to complete that again. Is the W-4 form changing for tax year 25? And I think I covered that. It's just a minor change with that qualifying surviving spouse. Someone asked if I hire someone from Illinois or Missouri, should I give them an Iowa W-4 for their home state? It all depends on where that Illinois or Missouri person is performing services. If they're working remotely, as I mentioned before, you're going to withhold in their state residence. If they come into Iowa, that Illinois person could fill out that non-resident form and you can just withhold Illinois income tax. The Missouri person, if they're performing services in Iowa, you're going to withhold Iowa income tax and they're going to be required to file an Iowa return. Someone asked again about how often somebody should fill out a W-4. It never hurts to have that occasionally, but I don't think you certainly have to do that every year. Somebody's asking if they should send in the W-4 form to review if they suspect it's completed incorrectly. Never hurts. The administrative rule just looks at, will the employee earn more than $200 per week? And if they indicate they're exempt, we ask you to send that to the Department of Revenue and we'll review that. Someone asked if you have a client that they paid income tax estimated amount reduced by the state and when they filed. I'm not sure what that question is. Just skip over that. There's a couple questions that it seems like they're specific to a specific account, so I'm not going to address those. If you want to ask me a question outside of this presentation, I'm happy to cover those. Someone asked if Iowa conforms with the IRS rules for federal disasters. The short answer is no, but as I mentioned before, if a taxpayer wasn't able to file a return on time or make a payment on time, they can submit that penalty waiver request and indicate, I think it was like reason five, that there was a disaster or flood, and they can have that penalty and interest waived. Someone said it doesn't really seem like it's a flat tax to me, and actually it is. In tax year 25, we are going to have a flat tax. In tax year 24, we still have, I think we have 3 tax brackets that get up to 5.7%. But in tax year 25, we truly do have a flat rate of 3.8%. So yeah, that is flat. It is a flat rate. No reciprocal agreement between Iowa and Nebraska. The withholding tables, I'll have to check on those. I know that they've been released. I don't know if they're on our web page yet or not, the new withholding tables. They might be waiting for the W-4 to be finalized before they release those withholding tax. Is IPERS exempt from income tax if older than age 55? Yep. IPERS is identified as one of the plans that's eligible for the retirement income exclusion. Someone says that they rent ag land to an owner that lives out of state. They provide a 1099. Are they supposed to withhold? And actually, the answer is yes on that. So you should be issuing a 1099 to them, and you should be withholding Iowa tax on the amount of rent that's paid to them. And it doesn't matter if it's a cash rent arrangement or if it's a crop share arrangement. Then I suppose if it's a crop share arrangement, the elevator would be doing withholding on the distributions to them. I think we're getting down to the end right now. Does this seem like a good stopping point for us, Megan?
Yes, I think it does. Thank you so much, Kurt, for sharing all that information with us today. As a reminder, this webinar was recorded and will be available to watch on our website or by searching for Iowa SourceLink on YouTube within the next week. If your questions were not answered today, we are going to email them to Kurt with your contact information, and he's going to try his best to get follow-ups to everyone. But as a reminder, Iowa SourceLink does not provide a continuing education certificate for your attendance today. We do, however, send out an email to everyone who participated within a few days after the webinar concludes that you can use as proof of your attendance. As Kurt mentioned, the next Iowa Department of Revenue webinar will be held on December 11th at noon. The webinar will cover the electronic submission of W-2s and 1099s. Check out the registration link for more information. Visit iowasourcelink.com and navigate to our tax webinar page to sign up today. Until next time, have a great rest of your day, and thanks for attending our webinar.
Yeah.